Good afternoon, everyone. My name is Ritika Sharan, and I'm a research intern at the Institute of Chinese Studies. It is with great pleasure that I extend a warm welcome to another edition of ICS's Wednesday seminar titled Comparative Assessment of India-China Consumption Patterns. Based on a study of consumption trends in India and China, the seminar aims to compare the size and demographics of the existing consumer base and the consumption expenditure in both countries. The findings reveal that India's consumption figures are disproportionately higher than China's, given the size of China's economy. This seminar argues that a large consumer market is not the primary factor influencing foreign investments. However, it can significantly impact a country's lucrativeness if the primary and secondary factors are no longer differentiate India from its competitors. The speaker for today's session is Mr. Amit Kumar, who is a research analyst in the Indo-Pacific Studies program at the Takshashila Institution, Bengaluru. His research primarily explores issues at the intersection of strategy, economy, and technology, with an extensive focus on China. His latest paper proposes a framework for identifying strategic and critical vulnerabilities in asymmetric trade relations between nations, with a particular emphasis on India China trade relations. The chair for today's seminar is Dr. Partha Mukhopadhyay, who is an honorary fellow at the ICS Delhi and a senior fellow at the Center for Policy Research. He was previously part of the founding team at the Infrastructure Development Finance Company. He has worked with the Export Import Bank of India and the World Bank in Washington. He has been on the faculty of IIM Ahmedabad, XLRI Jamshedpur, and the School of Planning and Architecture in Delhi. He has previously been associated with the Committee of Allocation of Natural Resources and with the Prime Minister's Task Force on Infrastructure. Recently, he chaired the Working Group on Migration (GOI), served on the High-Level Railway Restructuring Committee for the Ministry of Railways and the Technical Advisory Committee on the Ministry of Housing and Urban Poverty Alleviation. Additionally, he is a member of the Scientific Advisory Council of Learn Asia, Colombo. His research interests are urbanization, infrastructure, and the development trajectories of India and China. Before I hand over to the chair, I would like all participants to follow a few housekeeping rules. All participants are requested to remain muted during the seminar. You may post your questions in the chat box along with your name and affiliation. Alternatively, you may use the raise your hand option during the interactive session. After the presentation, you will be called upon to unmute yourself and ask questions. Thank you.
Thank you, Ritika, and welcome everyone to this edition of the Wednesday seminar. Today is one of the less frequent days when we're discussing something economic, and we're glad to have with us Amit, who has already been introduced to you, who's speaking on, we hope to get both a sense of the importance of consumption in these two countries. And as I think you'll find out, the story is not the same as the difference in the GDPs of the two economies. And also, from what I can see from his writings, look at how this particular difference can have implications beyond the economic sphere. Amit, about 35, 40 minutes. Is that okay? So the screen is yours, and we look forward to a scintillating discussion after the presentation.
Sure. Thank you. Thank you so much, Dr. Partha and Megha, for this wonderful opportunity. I'll just share my screen. Just give me a moment. Yeah. Is it visible?
Yes, it is.
Okay. Okay. So thank you everyone for joining in, and Megha has already introduced the topic. So let's dive in. So the objective of the study was twofold. The first was to compare both India and China's consumption trends, and the second order question was to inquire the correlation between large consumer market and how it can influence inbound investment. This is particularly an interesting question to work on, given lately the narrative around de-risking and diversification, and how companies are looking for alternative destination in case they want to move out of China, in case uh, in terms of when it comes to redirecting their newer investments. So how India's consumer market could play a role, or if at all, if it plays a role in that regard. uh, Three key judgments that come out, and this is a Takshashila way of doing it, wherein it's called reverse Bollywood format, wherein I present the conclusions upfront. So, three conclusions which I derive from this research is that India's consumption figures are disproportionately higher than China for the size of its economy. Of course, on aggregate level, there are differences, but for the size of economy, India's economy, the consumption figures are disproportionately higher. Second, a large consumer market is not a first order factor in influencing foreign investments. And this is true for India as well. Nevertheless, it can significantly influence the attractiveness of a country if the first and second order factors, which I'll list in my presentation, cease to be differentiating factors between the various countries. In this case, India vis-a-vis other its other competitors. Okay, so why consumption matters? So I have listed four factors which make consumption an important factor when it comes to economy. The first is that it forms one of the largest component, in fact, the largest component of GDP for most of the countries, except for a few export-oriented countries such as China or Germany. And by proportion, this is the leading contributor to GDP, ahead of private expenditure, government expenditure, and net exports. It's also a marker of investments on a broader level. I mean, there are other factors when you go deeper. The other factors that influence investment in a country, but on a broader scale, one can argue that consumption is a marker of investment in an economy. Third is innovation. So innovation is one peculiar thing which requires for a country to innovate and for it to sustain innovation in a particular category of product. It is important that that product of that innovation is consumed widely within the population. Unless it manages to do so, the significance that it attached to the product is meaningless, and therefore the innovation becomes redundant, and it might eventually stop, even though it might have potential. If it cannot commercialize on an economic scale, it might become redundant. Lastly, geopolitical tool. So consumption, of course, in India, if you look at India and China, for these two particular countries, demography has been a source of the geoeconomic relevance to the world, and this has in turn uh, uh, determined how major countries have had the relations or engaged with these two countries. And there are several instances in the past which show that geoeconomics has either cushioned or catalyzed the impact of geopolitical tide to their benefits. It is true for both India and China. Now, who's a consumer? Before we dive into this question, it is important to define a consumer. And while there are two or three definitions, I think the most suited one is the one by World Data Lab. And they define consumer based on expenditure method. And they define a consumer as anyone who spends at least $12 a day at 2017 PPP rate, which is roughly equivalent to 250 rupees Indian rupees, or 49 Chinese yuan in 2023. And if you look at this graph based on this definition, on your left hand side you have China, and on right hand side you have India. And this is the first image of contrast, when you see that China's consumers, the images are inverted, right? Between the consumers and poor, and between the poor and vulnerable. China is close to 900 million. China has close to 900 million consumers, while India has 70 million consumers. It's kidding. And when it comes to poor and vulnerable who spend less than $12 a day, for China has 524 million, while India has 950 million. And this is the first image of contrast. And this is based on the source where World Data Lab conducts extensive study on consumers and global consumerism. And it is a very, it is a, it has a good amount of data to back its research. Second, when it comes to projection, so this particular slide gives you a sense of how the numbers that both the countries will add in the successive years. So we are already past 2023, but if you look at 2023, it was projected that China would add around 36 million people to its consumer base, while India would add 31. But in 2024, the roles were reversed and the rankings were reversed. India for the first time became the leading country, which would add more people to its consumer base than any other country, at 33 million, while China is poised to add 31 million people to its GDP this year. Going ahead, India is likely to sustain its lead uh, and would add around 34 million people to its consumer base, while China would add only 32, just behind India. Uh, if you look at contribution by region to global consumer class, this particular year in 2024, you see that India will add about 30% to the global addition, closely followed by China, about 28%, and the rest of Asia together would add around 24% to the global consumer class this particular year. And both these data are from World Data Bank. Now, this is another set of image that gives you a sense of how the consumer class of respective countries would look like, or the top 10 countries would look like in 2030. And this is from Visual Capitalist. They are also involved in this kind of research and do extensive research on economy and technology. And they find that by 2030, China will lead the consumer class and will become a 1 billion plus country by 2030. In fact, it is poised to become a billion plus consumer market country by 2026, if I'm not wrong. And same goes for India. India will see a staggering growth of 46% from 2022, and will have from 2024, and will have around 773 million people uh, aggregate in its consumer class. This is closely followed by, not closely followed by, but very distant third position is taken by the US. It would have around 350 million people to its consumer class, and rest all the countries would have are very much far behind the first two countries, or even if you add the US, very far behind the top three countries. And you find no other Western country has that large a consumer market. But this also does not mean that these countries will be the highest spender when it comes to consumer spending. Of course, US will continue to lead the global consumer market in terms of spending because of high per capita income and high national income. Now, lastly, this provides a breakup of the growth that India will see between 2022 and 2030 for both China and India in various age groups, and the number of people that will add to its consumer class by age group. And here, the contrast that you see is that India will mostly add numbers in the younger category and the middle-aged category, while for the Chinese, you'll have most of the additions would come in 45 plus and 65 plus category. And this gives you some insights. First, that China will add more than 60% percent of its consumers in the age group of 45 and above. And the growth in India's consumer base will be equally led by all the age groups except for the 65 and above, the last one that we just saw here. Uh, and this would kind of make China a relatively older consumer class, and the median age of the consumers would be around 40 years. Uh, on the other hand, India would have a younger consumer base with a median age of 30 years, and this would respectively put China and India as the largest senior and largest young consumer market by 2030. Now, another trend that the people in the researchers in World Data Lab have uh, found out is that the global consumer spending will be led by elderlies, and that is 50 and above, and not the youngsters. And that is self-explicable, right? Therefore, despite adding more numbers to its consumer strength, India will fall behind China when it comes to spending. There are two primary reasons for it. One, the obvious one, that and the China has greater per capita income, so spending will be higher, right? And the second, that it will add more people, even though they will continue to add similar amount of people in the coming years. China will add more elderlies to its consumer class, who happen to be the highest spenders among all the age groups. Now, let's look at the consumption expenditure. So we do not have figures as to how these consumers spend, but we do have a proxy in the form of consumer expenditure, nationwide consumer expenditure, and that gives us a sense as to how the two countries are spending. So first, on your left, you have private final consumption expenditure. It is roughly you can equate it with household expenditure. And if you look at the numbers, India's numbers, the one in the blue is India, and the one in the orange is China, right? And India has consistently has had a higher per capita, a higher private final consumption expenditure as percent of GDP when you compare it with China. And there's a economic reason also why China's uh, PFCE is lower and is relatively less than many of the advanced economies, etc. And the reason is financial oppression, because China is a exports-led economy, and therefore you have a situation where spending by consumers have to be suppressed. So, in order to have a situation where those capital could be diverted towards manufacturing and export-led industries, and therefore you have a 20 point percentage difference between the two countries when you compare the private final consumption expenditure. Now on your right, you have final consumption expenditure. That is the addition this adds government expenditure to the private final consumption expenditure. And here also you see that India's expenditure as a percentage of GDP is in the upper range, is above 65%, and has lately it has increased to 68 to 69%, while for China it is somewhere around 50%. So the gap reduces when you compare the private final consumption expenditure to consumption expenditure. The gap reduces from 20% to around 15%. That also means that China's government spends a larger amount as a percentage of its GDP when you compare it with India. Now, a few insights that become relevant here is that given consumption powers most of India's GDP as compared to China, the former, I mean, India does not depend heavily on external market to keep its economy running, as against the latter. I mean, you still depend on it, but relatively, it depends a lot less than what China does. Alternatively, it also means that there's a potential opportunity for India that exists to exploit external market to drive its GDP. And largely, India's net export contribution to its GDP is negative. So there's always room, given India does a few things right and manufacturing takes up. India can leverage this to have a higher GDP growth. On the other hand, given that China is largely an exports driven economy with low domestic consumption levels, its ability to turn inside in event of a worsening external market is limited compared to, again, India. And this is what you see playing out in the last 2 or 3 years. And one of the reasons why, and we can go into detail in the Q&A session, why the dual circulation did not work, or the structural problems with the dual circulation was, and why consumption, given the worsening external market situation, China's GDP seems to be suffering. Now, this particular graph compares private final consumption expenditure in aggregate and per capita terms. In aggregate terms, if one looks at, you have these again, blue represented by India and orange represented by China. The Chinese have seen a consistent rise, except for these 2 years, 2019 and 2020, where it is stagnated because of the COVID years, and again it has taken up. But in 2022 has been some sort of a disappointing year for the Chinese. It was not able to sustain the growth that it saw in 2021, and it has again come down, and that's how you also see private final consumption expenditure coming down to $6.6 trillion. India, on the other hand, also again you see that 2019 and 2020, it kind of the growth, India observed degrowth, but since 2021, when the effects of COVID subsided, India has had a marginal growth. And I mean, if you compare it with the base level, it has been a significant growth. And on your right, per capita private final consumption expenditure, again, you have a situation where China was around uh, was at around $3,800 per capita in 2018, and this has increased to around 5,000 dollars in 2022. And India has also seen a marginal increase from 1,200 to around 1,500 between 2018 and 2022. And all these data that I have talked about of consumption expenditure, they were sourced from National Bureau of Statistics, China. And in India's case, they have been taken from MOSPI, the latest data that are available from MOSPI. Now, a few key, insights also become relevant here. First, that despite China, so if you look at China and India's economy, China is around 5 times uh, larger than India. But when you compare the private final consumption expenditure, it amounts the if you compare it, it only amounts to around 3.5 times of India, and this means that consumption is a much larger contributor to India's GDP, as you have already seen. Uh, but that it also means, and it's a relevant conclusion to draw here, is that India will equal China's consumption levels at a relatively much lower GDP, at say $10 trillion. The same amount of consumption that China had at 17 or 18 trillion dollars economy, India might achieve the same at a scale of $11 trillion, 10 to 11 trillion dollars. So that is a significant uh, conclusion that one can draw from this. Secondly, despite the gloomy narrative around China's consumption, its consumption expenditure has registered a significant increase in the past 4 years. But nonetheless, the problem still persists, and we can talk about that the Q&A session. Uh, and despite a setback that it suffered during the pandemic years, again, if you compare it to 2020, it has witnessed a huge uptake in 2021. And on the other hand, India's on a scale, if you compare it with the Chinese, it has been a marginal growth, but still significant if you compare it to other emerging economies. Thirdly, the year of 2022 again emerged as a year of contrast between the two countries. So you had a COVID situation and the impacts of COVID both in 2020 and 2021, and therefore it was expected that 2019 and then 2020, and it was expected that in 2022, after the effects of COVID was had subsided uh, by mid calendar year, you would have a situation where China would be able to sustain on the growth that it witnessed in 2021. But instead, China recorded a decline in its number, both aggregate and per capita, as we had seen early in the graph. On the other hand, in contrast to what China's position was, India witnessed marginal growth in both these categories. So there's some sense of optimism in that regard. Finally, in terms of the ratio, if you compare the consumption expenditure of the two countries, you find that India has closed the gap between gap with China from 3.3 to 3.1, and this is significant. And let me state why it is so. Because for a country like China that operates on a huge base of an $18 trillion economy, even a marginal growth would inflate the aggregate numbers manifold. And this becomes difficult for a country like India, which is a lot less compared to China, to catch up with it, right? And therefore, even if India was growing at a higher rate than China, it would become difficult to close the gap. But but in order to close the gap, India would have required to grow at a significantly higher rate uh, than China. And this is what has happened in 2022, where India outpaced China's consumption expenditure growth rate by a massive 12.5 percentage point. And therefore, it was able to bridge that gap to around from 3.3 to around 3 in 2022. Now, in PPP terms, again, there's a debate in whether PPP is a good marker when it comes to comparing GDP. But and that debate is open. But at least when it comes to domestic consumption, PPP, that is purchasing power parity, has a important role, and should be looked at in conjunction with the nominal figures. And therefore, if you compare consumption expenditure in PPP terms between China and India, you find that gap closes further, right? From 8 point, China has seen a growth. China's uh, private final consumption expenditure in PPP terms in 2018 was somewhere around 8.4 trillion dollars, and it has increased to around 11.2 trillion dollars in 2022. On the other hand, India has seen a growth from $5.3 trillion in 2018. And you see these 2 years in 2019 and 2020, where the growth kind of stagnated, but it has again picked up and has reached around $7.2 trillion in 2022. The gap is still there, but I think in terms of ratio, this has India has been able to bridge the gap. Again,
Uh,
in per capita.
Amit, if you can just quickly, sort of very briefly, for the benefit of the audience, just um, tell us what the PPP story is. That might
Yeah.
be.
Yeah, the PPP. So the numbers that we usually see during accounting, accounting is when you see the nominal numbers. That is called the nominal figures. PPP is when the nominal figures, the accounting that in which the accounting initially takes place, it adjusted with respect to exchange rates and the inflation. So you would have a situation when you compare, let's say, US or India, you would have a situation where both in nominal numbers you would have a difference, but you also tend to realize that in the same amount that one spends in India, let's say $100, an Indian would be able to buy a large number of goods compared to those, again, $100 that is spent by a consumer in US. So to adjust for that differences and to take into account that difference, PPP is calculated on nominal numbers, right? Again, in per capita private final consumption expenditure, if you look at PPP numbers, that is adjusted after take into account the inflation and exchange rate, you have a situation where uh, China has done exceedingly well, and it has increased in per capita terms, both in PPP and nominal numbers. You have seen China stretch the gap because you had a situation the last 2 years where its population continued saw a decline, and therefore the per capita numbers, that is the total aggregate number divided by the population of the country, is calculated. You see a rise, a relative stretch between India and China, right? Again, lastly, this is the growth percentage that the two countries have seen in the past few years. On your left, you have consumption expenditure growth, and on the right, you have per capita consumption expenditure growth. And both on the left, you see that the growth, when it comes to growth, the two countries have largely tracked each other and have stayed close to each other. And they declined again in 2020 due to COVID in 2020, but a break was observed in 2021, right? Before this, in the preceding 4 years, you had a situation where they were closely tracking each other, but in 2021, there was a break on both the charts. You can see that, and India has managed to sustain the growth rate in 2022, while China has witnessed a decline, uh, concerning decline in 2022 after the economic effects of pandemic, if I would say, had subsided. And the same is true for per capita private final consumption expenditure. So again, China has India has in fact outpaced China in terms of the growth rate, if you see, in per capita private final consumption expenditure over the years. But a significant breakaway is seen from 2021 and 2022. We are awaiting the 2023 data. Mosby will probably release it by the end of this year, and we'll have to see if India has managed to sustain that growth rate and what happened to China. Now, expenditure by category. This is also important, and to kind of see where the two countries are spending and what category of goods and services are the two countries spending. And because this gives you a sense of how mature an economy is. So on your left, you have data from 2022 from China, and on your right, you have expenditure category from India in the financial year 2021 and 2022. Uh, you see, in both the countries, food and tobacco and liquor, etc., constitute the leading sector, leading category where expenditure is made by the consumers. In China, it is followed by housing and then transport, education and healthcare. In India, you have a situation where it is followed by transport, then household equipment. Housing constitutes a very minuscule percentage if you compare it with the Chinese, and other clothing, footwear, and healthcare. And you can see how the two countries contrast here, right? And a few key insights also become relevant from comparing the consumption expenditure by category. Uh, India's consumption expenditure is largely categorized by higher spending on food, clothing, footwear, and transport, and a lower spending on education, culture, recreation, and healthcare. You can see that here. Uh, Healthcare, culture and recreation, education constitute very minor categories of expenditure compared to China, which constitutes 10 percentage and around 8% in healthcare and 10% in education and culture, right? And this makes a difference. So, and this makes a difference because China's consumption basket, if one sees, it represents a relatively developed market in comparison to India, of course. And the food and beverages constitute, even though they constitute the biggest chunk of their consumption, its percentage is declining when you take into all the other sectors in account. And this is a sign of maturing economy, right? A maturing market. Additionally, it spends higher percentage on expenditure on housing, white goods, recreation, as we just saw, than India. And to put things in perspective, all the advanced economies, you have US, Japan, EU, UK, and France. They spend a lot less on food and more on recreation and transportation and leisure, etc. And that gives them a sense that that gives you a sense that they are they are an economy that are on the more matured side of the line, whereas India is still a developing market. Uh, Again, if you look at aggregate numbers, these two graphs represent the aggregate numbers of how much do India and China and India spend on each categories. The one on your left is from 2019, and the one on your right is from 2022. India's figures for 2022 have not been released by the MOSPI yet, the Ministry of Statistics and Program Implementation. But you have the Chinese numbers, and here you see that even though India constitutes one-fifth of China's economy, in three sectors particularly: food, transport, and clothing. These three sectors are where India spends almost half of what China does, and that is again significant when it comes to comparing the the consumption in the two economies. Right, despite being one-fifth of the economy, they spend almost half of what China is spending. And we would like to see such trends in other categories as well, especially when it comes to housing and household equipment, because those are the white goods where it could really drive manufacturing growth and etc. Again, this is what I've already covered in the previous slide. Now, indirect tax collection. This is another indicator of the consumer market, and the data has been taken for India has been taken from GST portal, while the data for China was taken from NBS, right? And it gives you a sense that China, in fact, collects a lot more tax than India does, and that could lead to a lot of relevant conclusions. But one of the conclusion is that I mean, in terms of expenditure, they are the ones who are spending more, despite there being disparity in the numbers, or some disparity in the numbers. And but again, as you saw that China in 2022 did not perform well, this tax collection rate has come down, and as the growth rate has come down. And India has, again, the breakaway is observed in 2021. And India has sustained that growth, while China did not manage to maintain that growth, that it uptick that it saw in 2021, and did not manage to capitalize on that. Now, the question arises, having seen all the consumption trends so far, the question arises is whether this large market that India has, and only the market that can maybe compare with US or China in the coming years, does it hand it an advantage in dealing with its rivals, especially in the context of the de-risking and the diversification narrative, where companies are looking for alternative destinations to invest their new allocations. And one finds that in my research I found that this is overstated and exaggerated, and I've listed some in detail why it is so. But the conclusion that came out was that it is a third order factor in influencing inbound investments into a country. The two factors, the first order factor, and why it is so, you have examples and you have results which show that India's competitors in China plus one narrative are countries like Vietnam, Malaysia, Thailand, and Mexico. And none of them, except for Mexico, figure in the top 10 markets, consumer markets. And yet, India is finding it difficult to compete with them when it comes to attracting foreign investments. Uh, and the reason is that there are two primary factors that play a role before consumer market comes into play. The first one is the openness towards foreign investment in a country. And OECD has a index that it prepares on for all countries, a very detailed one, where it compares countries on their openness to foreign investment. And here you see that the line in blue here is the one that represents India. And if you compare it with other countries that I've listed here who are potential China plus one competitors, including China, you find that India has managed to perform satisfactorily on this account as well. So first order factor is something which India has well taken care of. But there is a second order factor, which becomes important after you have kind of approached and have gone past that first order factor, and that is ease of doing business. And ease of doing business is an extensive it takes into account an extensive list of factors relating from land acquisition, electricity, corruption, bureaucracy, red tapeism, the lead gap, or how much time does it take between an inception of a project and then actual first production of out of that factory, etc. And on that account, if you see the rankings over the past few years, this ranking was the World Bank stopped publishing rankings after 2020. But if you look at the rankings over the years from 2006 to 2020, you find that India has lagged behind massively when it comes to when you compare it with its competitors, which have had the advantage of a business environment which was very easy to work with. And this is where something, and you see a drop in India's rankings and from 2017, but still other countries managed to outperform India. And again, lately you have seen some instances where businesses on a higher level, on where a government is involved, you would see that there have been speedy processing of one's proposal. But when it comes to middle level, mid level, and low end manufacturing companies, those benefits are not available to them because the government is not directly invested. And that is something which has been a concerning factor for in businesses looking to invest in India. Nonetheless, businesses are still optimistic about in the Indian market. But the proposition here that I'm trying to make is, if you make this thing easy, uh, you can leverage your consumer market a lot better and effectively compared to other countries, because none of these other countries, leave China is already ahead. But we are comparing yourselves with other countries which are now vying for the spot, China plus one spot. You'll manage to effectively outpace them if you manage to, if the government manages to take care of this thing. So, lastly, and this is my last slide, and I'll end with this. The conclusion that I again draw, and I would like to reiterate, is that the existence of a large consumer market as a factor would only, in India's case, would only become relevant and influence inbound investments only if the first and second order factor cease to be a differentiator. And on the first order factor, the data already suggests that India has done well, but it is the second order factor, and that is the business environment, where India is lacking behind its competitors. And the economic logic suggests if these two are taken care of and remains a constant between the competitors, that is India and its competitors, market size can play a vital role. And in fact, it will be a factor of exponential order, because that again creates incentives for companies to shift if you have a larger market here. Already in terms of labor and wage rates, you have an advantage. But again, labor regulations make it difficult for the companies who want to invest in India. I'll end with this, and I'll be happy to take questions.
Thank you, Amit. Thank you for sticking to time and being very clear about evidence that you're presenting. I see one raised hand. Is that Ravi? Could we? Can you unmute yourself? Or okay, I have to ask to unmute. That's fine. Yeah.
Thank you very much, Amit. Thank you, Partha. Amit, that was a very detailed and very welcome presentation. This is indeed a subject that requires a lot of study, and I'm very glad that you have started on this pathway with this very detailed presentation. So I have basically 3 comments. One is, you might be aware of Nicholas Lardy's work on this whole business of China's level of consumption expenditure. Very briefly, his case is that China's consumption expenditure is underestimated, and actually it is more. And he estimates it to be 6 to 7% of GDP, more than the present number of around 37. So that brings it to about 45 or so. His paper is from the Peterson Institute of International Economics on the 9th of April this year. So I think this is one point that I want to make. The second point is, and let me just complete this. The reason for this gap, he says, is that the social transfers from government subsidies to the personal consumption are not included, i.e., for example, education, healthcare, subsidized food, subsidized canteens, whole list of things that China's government has by way of welfare benefits. And of course, India has some too, so we will have to tally those as well. The second point is on the question of how much consumer expenditure matters for incoming investment. I agree with you that the size of the domestic market is not that important because, for example, if you're an export market, like all these Southeast Asian countries are, they're members of the RCEP. So in fact, the whole of the RCEP is their market, so to speak. So what is important is being a member of one of these trade groups. And secondly, what is also important is the whether the consumption expenditure, how equal or unequal is it? Is India's consumption expenditure tilted towards the upper end, the famous or infamous K-shaped recovery? That's my second point. The third point is how much of India's consumption expenditure is driven by debt? One hears that the RBI is quite concerned about debt in Indian households for reasons of healthcare principally, but also education, and even for buying consumer goods like iPhones and so on through credit card or through EMI schemes, etc. So I think there are a number of other factors. It's a very complicated issue, I think. To really arrive at a true comparison, perhaps one has to look at all these other factors together. Thank you very much. I'll stop here.
Amit, you want to take Ravi's question? Because that's
Yeah,
quite substantive structure, and sort of begin there, and then we can take other questions going forward.
yeah. On the issue of under accounting, I would say that yeah, I've gone through Nicholas Lardy's that piece in Pearson Institute, and uh, I would like to differ on this because when the figures that I've compared is from GDP and GDP accounting and what percentage of consumption goes to towards consumption goes towards GDP. So I think the problem of uh, differences would not come in here. Where the differences would come in would, and this is what I found in my research when I was comparing. I initially thought of including uh, per capita income into my study and to look at it, and that is where the problem of counting and transfers and subsidies would come into question, because when I looked at the differences and the graphs of both national per capita income of India and China, I found that in India's per capita income, the gap was startling in the sense that it was I expected to be a lot more than it already was, and this is where I looked at the NBS data and found that this was a problem, and I was not sure of the data, and therefore I did not include it in my paper. The gap that the anomaly that you're talking about would perhaps come where the national when national per capita income is accounted. But when it comes to accounting consumption and from accounting GDP and the consumption expenditure approach to accounting GDP, I think that is all well taken care of when you have make a macroeconomic level analysis. And again, despite that and point taken that there are things that the governments do to fudge their data, some things which are not included. And this was a disclaimer I should have given at the very beginning, that this is strictly on the basis of what the two countries present in their data sets, right? Inequality, yes, there is a merit in this argument, and to what extent this consumption is driven by the higher echelons of the consumers and leaves out the poor and vulnerable, and which is true, which is not in contention. Obviously, when consumption is mostly driven by the middle income, and therefore we always get to where is India's middle income, the question around the middle income or the higher income countries, and that's the I think a drawback of comparing consumption, that consumption will most likely be driven by the middle income families and high income families. Although there are at least in India's respect, there is a case to expand the consumer class and beyond the traditional margins of middle income, and you require a situation where you have more and more poor and vulnerable coming into this situation. But this category, right? And well, the point is well taken that there is inequality, and largely the consumption is driven by the ones who are affluent and rich. What becomes important is how uh, quickly is your affluent class growing, and when you compare it, and that's again another question for another paper and something for Invest India to look at. But yeah, this is a important question. Consumption driven by debt, yeah, it again a point taken that this is a very important point, how much of this consumption is driven by debt. But again, if you look at consumption driven debt, it will largely be concentrated in the poor and vulnerable, and will largely be concentrated in the categories of food, clothing, etc. And therefore it becomes important to track the consumption of white goods and how that trend is shaping up, because it's unlikely, I mean there could still be cases, but it's unlikely that consumption of white goods would be driven by debt. Debt is usually taken to cover your very needful expenses, and food, clothing comes into that category. So yeah, I agree. That's all.
Do we have further questions on this?
Thank you, Amit.
Um, though, yes, I can see someone else who's coming. Aram Ashraf. Let me, yeah. Uh, if you could quickly introduce yourself and then sort of ask a question, that'll be done.
So, well, still good morning from me. So thank you very much. That was really, really fascinating to watch. So my name is Ira Mashraf. I work on China-Pakistan economic corridor, but really it's China's the Belt and Road Initiative in South Asia that I'm interested in. So as I was listening and watching your presentation, I kept on going back to this debate by Intelligence Squared a long time ago, which was talking about China's rise is despite its government, whereas India's rise is in spite its government. So I kept on going back to that. And also in reference to some of the issues surrounding China's GDP, I'm thinking here of Michael Pettis. You must be aware of his work, The Economist, because he was the one who flagged up for me the idea that do not take China's GDP in the same way that we take other countries' GDP. So the thing that I'm interested in, I wanted your opinion, is one of the reasons people often point towards the rise of, I suppose, like you pointed out, China +1, Vietnam, and all these other areas, is the role of sanctions on China. And as a result of which, Chinese companies moving into those countries and trying to make, those countries work for them instead. And that's why I'm interested in what you were saying in terms of certain restrictions from India's side in terms of FDI. And so if you could help me understand what are those issues which you were pointing that perhaps India should open up its market further, the government way. If you could elaborate a bit more on that, that would be helpful. Thank you.
Right. Yeah. Yeah. To answer your question, I think first on China +1 and the relevance of China +1 and how effective that could be to drive India's growth. I think there are indeed parallels when you compare China in 1980s and 90s and India of today. One of the three parallels is that there is a global effort towards restructuring of global supply chain. And at that time, it was driven by countries, businesses who were trying to drive down their uh, operating costs and looking for an alternative market to set up their factories. And China and other East Asian tigers emerged as lucrative options. And today you see again a shift of that order arising from the efforts towards de-risking and diversification. Although the difference here is that you will never have a kind of a situation where or the gains to be derived from this situation as you had back in the glory years of globalization. Having said that, there are gains to be derived. Now, this is where the question of India and other competitors of China +1 comes in. And why, and yeah, you're right, there are, so the companies operating, the foreign businesses operating in China are at the receiving end of this double whammy where both the US is taking out punitive measures and nudging companies, at least which it regards as strategic and critical, to move out of China. And then you have regular Xi Jinping's regulatory overreach, which is making it difficult for the companies to uh, operate in China. And this has brought some sort of an alignment between the US administration and the US businesses or the European businesses, which was initially thought 2 years before. I think it was thought that it would be difficult to emerge given their varying approach to the China policy, wherein the businesses wanted to be a lot more engaged as compared to the US administration. And therefore, in this situation, the question of India comes in. And again, so that part is answered. But when it comes to India, the problem is the government. There are sectors where the government. So the FDI or the openness to FDI or the foreign investment is marred by a couple of factors. One, you have not carried out structural reforms in your own economy, which make it vulnerable. And there is a strong uh, uh, negative perception, pejorative connotation attached to increased imports. And this is something which prevents domestic compulsion, the narrative around increasing imports, and even how you see the India-China trade thing gets politicized of increased trade dependence and etc. So there is a fear with regard to domestic narrative that would develop if you have not carried out and not being able to compete with those sectors. Second, there are powerful lobbies that work inside that work in India and have a complete monopoly. Dairy is one sector. It's a good example where they lobbied very heavily with the government against joining RCEP, because they didn't want to lose the market. They have no interest in competing in countries outside India, and they're very settled with the kind of market share. And if you have the problem with the dairy is a problem is that you have cooperatives. So not only you don't want to compete with countries outside India, you don't want to compete with countries that have their foothold inside certain regions. So Amul wanted to get in Bangalore, and Nandini, which is a cooperative milk dairy cooperative station in Karnataka, that has a foothold in Karnataka, it was completely opposed to it. So the thing is that they have powerful lobbies, and they manage to extract a lot out of the government, and that then complicates these issues. A good thing is that at least in the manufacturing sector, the government is starting to think and make has is becoming more welcoming of such situations. The example of Apple and Foxconn, Apple, from what I know, Apple had a strict demand that will only move into India if you allow these kind of imports, and take out this restriction on Chinese imports, because a lot of their back-end supply chains are still present in India. And even though Apple makes a move in India, you'll still require those back-end supply chain to provide you important components, right? So a good welcoming change in that regard. But in areas where the government might think it is of strategic interest, or might give some benefit to their local manufacturers, that still become a problem, where the government might not be very welcoming to foreign investments. I hope that answers the question.
Thank you. There is also a question by Mr. Chopra, and I'll then sort of move to reply. Mr. Chopra, could you sort of elaborate a little bit on your question? Because I'm just asking you to unmute, and then you can take it from there.
Thank you very much, Partha. This is I'm Admiral Rakesh Chopra. I want to know that the government is tom-tomming about India's centenary goal in 2047 is to become a developed nation. Why? And this is, to my mind, a little woolly sort of a goal, whilst China has got it very clear that it wants to have a first-class military, wants to have 25% of the global trade, and wants to be on top of the geopolitical totem pole. So that's very clear. But what is this being a developed nation by 2047? What does it imply? I've got no firm sort of information on that. Could anybody tell me that, what it means?
Do you want to take that, Amit?
Yeah, sure. So clearly the narrative around 2047 in India being a developed nation by 2047 is a political narrative that we want to build. On the question of, I mean, they're very, the problem is the government has not quantified it, as you said, because you don't have a clear quantifiables which can actually go on to say that, yes, you have become a developed country. One of the factors that I think the government keeps harping about the global GDP or the aggregate GDP, and that the fact that we are the fifth largest economy and another 2 years will be the third largest economy. And from the likes of it, it looks like that the government will harp on this, the fact that it became the third largest economy in the next 5 years. We are on track to become a developed country by 2047. Of course, it's too far in future, and I think there are a lot of things that we need to do in immediate and short term to actually think of. I mean, there should be a guiding compass that should lead to that, should lead us towards that. But there are a lot of short term and medium term challenges that we need to look at. One of it is, I mean, indeed, if you want to have a quantifier, and want to go out and state that you want to become a 2047 become a developed country, one of the prime factors that you have to have that you have to take into account is per capita GDP. So at current levels, India is around $2,500 dollars per capita, right? And it is around one fifth of what China is today. And it kind of concerns me, right? So China in the past 4 decades, I mean, before 2020, in the past 4 decades, had the most miraculous growth of 10% plus GDP growth, right? And yet uh, it has reached a point where its per capita GDP is around $12,500 dollars, right? And it has slowed down at a much lower level than many of the advanced economies in the East Asian tiger countries did, right? At 35,000. And now their economy is slowing down, and the implication that it has for its per capita income, or developed country, or what they uh, term as advanced socialist country, modern socialist country. Uh, the fear here is that they might not be able to jump into the high income or the upper high income countries. And now, if that is the case, now with China example in hindsight, you look at India, and India has not had that kind of India has that kind of a growth, but not the kind that China experienced the last 40 years. And yet we are at 2,500 per capita GDP, right? And it would take another, if India continues to grow at around 10%, it would take another 11 years for India to be where China is today. And God forbid, there are a lot of factors that as it emerged in China's case, there are a lot of factors that can go wrong. There are geopolitical risks, there are geoeconomic risks, which can impede your growth and slow down your economy. And the problem with that is the problem of narrative economics. So once your economy starts to slow down, narrative starts to play a bigger role. And I think this is a very understated, we don't appreciate the uh, weightage that narrative economics enjoys over a country's economic outlook. And the narrative in case of China, despite having performed well in some sectors, have gone really bad, and that is impacting its slowdown and further accelerating its slowdown, in fact, right? So I don't want to get into that situation where India's the narrative around India's growth will come in question because you did not manage to get short and medium term things sorted out. And it will take a lot of time to overcome that narrative. So I think that's a political gimmick. The 2047, it's too far ahead in future, and one does not know. I mean, you do not know in by 2030 if India will manage to integrate itself, if it will be able to leverage the current opportunity, the geopolitical and geoeconomic opportunity that lies ahead of it, uh, whether India will be able to leverage it. So to talk that far in future, I think it's a political thing. It's a political thing, has political benefits, but I think for me it's too far in future. And if at all you have to put a quantifiable, you have to quantify it as to when India will become. I think 25-30,000 per capita GDP is where we would. I would like to see India by 2047, though it's looks improbable and near difficult, but that is something which I think if we manage to get there, India, we might call ourselves a developed country by 2047.
Can I just continue? Can I just continue, please? If you
Go
go
ahead,
to
Andrew.
China, if you go to China, it's and the infrastructure. What you see is unbelievable. And Shastri Ramachandran, who's just written a book about binaries of India and China, he says, in his opinion, development means infrastructure. So, would you agree to that? And he has it. Shastri is also not even quantified in terms of GDP of 50,000, which it appears impossible, which UK I think is today. So, can we quantify it in terms of uh, infrastructure, if you like?
No, actually, Admiral, it's not that. There are within the international discourse, there is, as Amit was sort of alluding to, uh, the way we think of high income countries. The World Bank has a threshold right now of about 14,000 US. which is a high income threshold at this point in time. And if we are currently, as Amit mentioned, about 2,500 US, and basically, if you have between now and 2047, which is about 23 years, if you have about 8% growth in per capita terms, now assuming our population isn't going to grow very much more, that's roughly the same as overall GDP terms. If your GDP is growing at about 8% in dollar terms, which is not impossible, but it is doing it consistently for 20 years requires a lot of stretch, and that's where China essentially did much better than most other countries. Then we will be at 14,000 in 2047. So in that sense, if you're looking for specific targets, a growth rate of about 8% per capita will get us in 2047 to what is considered to be a high-income country in today's standards, and presumably in those standards, because these things will adjust as things go on. And on the infrastructure front, I'll let Amit answer, and then if there's something else that I can always jump in. Yes, go ahead, Amit.
Not really on the infrastructure. Infrastructure is one thing which has spillover effects on your economy. But again, how do you? Only thing that I can look for to compare. Infrastructure is something that you can see and tangible. But when it comes to accounting for it, how do you account if a country is particularly? You can take a look and say that this country is infrastructurally more advanced. But again, it comes down to numbers and a way where you can put all this into accounting. And in that regard, I think GDP and GDP per capita, more than GDP aggregate becomes important. And I think I would still like to go with per capita as a metric to see if India is a developed nation or not.
What will be your target for your GDP, per capita GDP?
My target, I would like to see India, by 2047 or in
2047.
general?
I'm specifically on 2047.
Yeah, by 27, I don't know, I'll have to make the calculations, but I would like to see India somewhere around 35,000 per capita GDP to be called. The lower threshold is 13,000, 14,000, whatever the number is. But I think if you compare with the top 10 economies in the world or the top 7 economies in the world, you leave us out India and China out because they have a disproportionate economy given the large population. But China, US today is at $60,000, right? You have Singapore, country like Taiwan, etc. They're all 35, 40,000 above. You have UK at 45, around again 45,000. You have Germany around 50,000 per capita, if I'm not wrong. So all these countries are at a level which are in excess of 40,000 above, right? So India at least has to be at least, and we shall not be content in that even at that point of time, but at least if you have to punch above your weight, and in a lot of categories, India needs to be at 35,000 per capita income. The goal should be that.
Thank you very much. Thank you. Very kind of you. Thank you.
Very well. Mr. Rapai, I'll just sort of
thank you,
to
Partha.
unmute. Yes, go ahead.
Yeah. Thank you, Partha, and thank you, Amit. It's fascinating to listen to you, even though I'm not a pure economist. So, and a lot of things you said may not make all the sense to me. But two questions I have is, one is the consumption. Will a growth in consumption will automatically attract investment? Because investment is much more complicated. And I don't know, are you factoring in the quality of our population, especially the workforce, which is available to us to attract more investments? That is one. Secondly, the PPP, PPP, I'm not totally against PPP, but it has a lot of complications in calculating. On the PPP based, you can produce numbers, but that won't go down to the ground level. And the infrastructure, I don't want to get into that this thing again. But I think what we are talking about infrastructure growth in India, it may be swanky highways or things like that. But we saw in last Friday, one rain and Delhi roads collapse. So I think it is much more than, I am not even bothered about the highways. But what is happening to our rural connectivity? Where the consumer is there, where the producer is there, where all this will lead? Can you give me some sense? Because I know that from a common man's point, I am asking. Thank you, Amit.
Yeah, on the question of the quality labors, right? So it's also a function of how I mean, of course, if you compare India's labors with the ones in Southeast Asia or East Asia or China for that matter, uh, they are not comparatively skilled if you compare to them. But it's also a function of the companies that you have, the legacy companies or the companies who have historically been present in that. And training of labor, although important inhibition, it is something which the companies are not very worried about. So training or the skilling of the laborers is one something which, I mean, given other conditions are constant, is not something which would be a inhibitor in getting companies in India. I'm not discounting that. In fact, I think I did mention in my paper, and just not in the presentation. The skilling is not that big a problem for the companies. It would hardly take them around 1.5 to 2 years for them to train. If you look at the example of Foxconn is one of the most specialized companies, and when it comes to because there are a lot of specialized components that are involved, and that goes into manufacturing. It only took India 1.5 years to get used to the thing, and the last iPhone that they produced, I think 16, I think, the time that they had set, that the return time of the entire processing time that India needs to target, that was achieved within time, right? And at par with, in coming 3 to 4 years, India will be at par with China when it comes to producing iPhones in that limited period of time. So skilling is not that big a problem, given you can get the companies to invest in India. And for that, there were other factors that I talked about. So that answers the question. On rural connectivity, yes, in fact, that's a good point, because in fact, India's consumption, as in contrast to China, if you look at, is largely distributed between the urban areas and the rural areas, right? And therefore you need to have infrastructure. One problem with India's consumption, or the rural consumption, is that rural consumption is more traditional in nature. The consumption is not towards the which is directed or geared towards big companies coming in and things. People like to have things fresh, right? And I think that's something which India should maintain, unlike China, where everything uh, the urban areas concentrate, the consumption is concentrated more in urban areas. In case of India, I would like to have a situation where you have room for both MNCs and local stores, kiranas, etc., which serve the rural consumers, right? So I think there is a need for a balance in there, and I think it's not a problem. I mean, yes, infrastructure should be there, and no questioning. But if what you're directing is that because the rural consumers are not able to consume, or the nature of consumption is more traditional and has not kept pace with what the urban consumers have done, I'd like to see a much more balanced consumption from that regard. And rural areas, I mean, even though they spend a lot, their consumption is traditional in that nature, and I'd like to preserve that. It should, I mean, I would like to preserve that, and that balance to be there when it comes to India's consumer market.
Mr. Rapai, anybody else needs to have?
No, only I would like little clarification on the PPP part.
Oh, right, yeah, people.
It's a,
So I'm so sorry.
that is a lot of problem area.
Yeah,
Thank
see,
you.
there could be problems with the PPP, and in how PPP is accounted, but and there are problems with how every other country accounts for PPP, and there are diversions. But that's a disclaimer that I'm working with, and the one that, I mean, it still makes a case for do a PPP comparison. You can go into questioning whether the accounting was right or not, or whether it can be perfected. Of course, there is room for a lot of correction in that sense. There could be problems, but I mean, PPP still becomes, I mean, given what we have, PPP still becomes a relevant factor to look into, and not in isolation, but in conjunction with the nominal figures, right? I would say
No,
that.
I'm not arguing that to throw it out, but I think it must be more convincing to the public. Okay, thank you.
Thank you, Mr. Pai. Are there any other questions? In which case, I was just, while people might want to look through, Amit, what you just mentioned about rural and urban. Now, if you go back to what Ravi was asking at the beginning, one of the large section of social security payments in China is actually formal pensions. And you also mentioned the whole issue of the demographics of consumption in China being much more older going forward. So I'm just asking you to sort of speculate as you go forward as to whether, for two reasons. One, how do you think the fact that the urban-rural mix in China would sort of affect the growing urbanization of China would affect the consumption going forward? And secondly, the issue of age. And as you said, the people who are older would tend to spend more because they have less reason to save, and therefore would produce a larger, not only consumption, but also presumably consumption of services rather than goods. And given that, do you see that the consumption basket of China would be much more services oriented, and the share of consumption as a share of GDP also rising because of demographics as well as because of the move to urbanization? And in that context, would therefore the past be less a prediction of the future? I'm just drawing on the insights that you were sort of pointing out in your presentation. So how would you sort of respond to this kind of scenario?
Right. The first question on rural consumption with respect to China, right? So China in the past few years has identified that consumption is something that, I mean, given the traditional drivers of economy, the exports and investments have stopped firing. Consumption is what they have turned to. And when it comes to consumption, there is little room for expanding the consumption of the urban classes. And this is where the government has taken a conscious decision that to tap into the hinterlands and the rural areas. And this is what they're trying. They've been trying to do that for the past 2 years. But again, rural consumption is something that has not taken up, or consumption as a whole has not taken up. And the I would say I don't know what other plans do the Chinese have, but one way to do it would be rapid urbanization of the rural areas itself. And I mean, there's no clarity. I mean, they do say that greater urbanization is the way forward, and I think that would be something that is the way forward when to solving the consumption problem of the rural hinterlands that they talk about. And not just expanding the consumption, but instead turning them into an urban centers and then maybe driving the consumption. So going forward, you would see larger urbanization, and as a result of it, maybe more rural areas, you'd see consume more. Second, on the question of the types of services, yeah. So it's interesting as while I was doing this study, I was confused, and I wanted to speculate on what kind of services or the consumption or the services and goods consumption would go on to cater for these elderly consumers, right? On one way, you can argue the fact that they'll consume more. One way you could argue that they'll spend more on healthcare, other leisure activities, etc. But you'd also see that they might not spend more on things like white goods, because by the time that they are at the stage of their lives, they would be quite settled. And if they are they're more geared towards spending on things like healthcare and leisure services. And by that time you would expect that they have their own homes and their own vehicles, etc. So that kind of that gap that it brings, that or that it gives you, where you would have the demand for these kind of things, for household equipments, white goods, etc., cars, and vehicles, and things like construction, is something which will be driven by middle-aged people. And so there are both contrast, and you could have a situation where while they are spending more, the demand for where India wants to get in would come from the middle-aged section. So this was one thought that I had while I was doing the study. I'll have to look more into this, and what kind of consumption pattern or nature would the elderlies have. But surely leisure and healthcare would be the ones that would dominate their consumption.
Thank you. And as it turns out, I was just checking through, is the difference between the consumption patterns of um, rural and urban India in many respects is not very different. There's obviously a difference in things like rent and so on. But if you look at the recent um results of the household consumption expenditure survey, the share of different goods, etc., the pattern is less different than one would sort of expect it to be in some sense. So there may be something else also happening there. Does anybody else want to come in? Patricia, do you have something in place, or else I'll hand it back to Ritika. Colonel Sahai. Uh, Very well. And finally, then before we finish, Amit, if we do you have any thoughts? I see that you mentioned the fact that um, consumption alone is definitely not a driver, but given that the sizes of the consumer markets, do you think it is not a sufficient condition, but do you think it is a necessary condition? And is that one of the reasons why, let's say, China doing it more as an economic security reason, whereas we would therefore, um, in some sense, our efforts to sort of move from domestic to international consumption, would that make us less secure than what China is now trying to do, is become more secure by moving more of its dependence onto domestic consumption? Is that something that we should be worried about, or is that something that we should only worry about once we get to China's levels of consumption?
Oh, that way. I think China has structural problems in the fact that it is trying to turn inwards is a lot to do with the structural foreign policy challenges that it has manufactured for itself. For a lot of time, people thought that China's rise would be a peaceful rise, and China itself, Hu Jintao, I think, said that China's rise would be a peaceful rise. But in the last 5 years, China has manufactured foreign policy challenges for itself, but has spooked both the administrations, the Western administrations, and the businesses, I think. I hope that is something which our foreign policy, diplomats stay clear of. One challenge that I see in that respect is the clash of values that you see with the Western countries, right? And I'm told by some US diplomats and the few that maintain close relations with the US administration, that while in India we would like to think that values might not be a problem, the clash of values might not be a problem, and given that there are sufficient overlap of interest, strategic interest between the US and India, insofar as China is concerned, and therefore the US would be willing to make that concessions very often, if even if values go in conflict, right? The one that one of the instances that we saw with recently is with the Niger and the Khalistani uh, uh, episode that we have had, right? And India still has that kind of diplomatic clout where you would diplomatic capital and where the US might let you off, but you need to make sure that the diplomatic capital is not dwindling fast, right? And so it would not depend on the foreign policy environment, how it is for India, insofar as for India is concerned. The reasons for China to go inwards is a lot is to do with both the structural factors that I mentioned, and also structural foreign policy challenges that I mentioned, but also some of the structural economic challenges that it was facing, right? A lot of investment was geared towards it was, since it was an exports driven economy, and after 2008 you had a situation, and if you look at China's numbers, net exports as a percent of GDP in the first decade of 2010, and compare it to what it is right now, you would see there's a vast difference between the numbers. It is despite encouraging signs in the last 2 years on net exports as a percent of GDP, it is nowhere close to what its contribution was to its GDP in the early in the late 1990s and early 2010, the first decade of 21st century. So it was a conscious decision to go inwards, and the second reason was that investment, which the real estate formed the core of its investment-led strategy. So government again made a conscious decision there to disinflate that bubble, and that impacted growth, and therefore they have tried to go inwards. But I would say there's a structural problem with this approach as well, given given the fact that China still wants to be an export-led economy, and for that, there's a certain trade-off between consumption-led and export-led economy. You can't be both simultaneously. You'll have to give up one in order to become the other. And this is true for even Germany, which is the export-led economy. It is so because you have to divert financially suppress your consumers so that a lot of capital is redirected towards manufacturing, which you can export. And this is one structural problem which with their dual circulation strategy as well. They don't talk about it a lot often nowadays, but yeah, this is the problem.
Thank you. And if there are no further questions, let me take this opportunity to thank you for your work. And as Ravi said at the beginning, we hope you'll be looking at this issue in more detail in the times to come. So Ritika, the screen is yours.
Thank you, Dr. Mukhopadhyay. I seek your permission to formally bring an end to today's session.
Please do so.
With this, we come to the end of today's seminar. We thank Mr. Amit Kumar and Dr. Partha Mukhopadhyay for gracing today's seminar with their presence and for giving us their precious time. We also offer our gratitude to the audience. The video of today's seminar shall be available on the ICS's YouTube channel. We extend a warm invitation to all for the upcoming Wednesday seminar scheduled on 10 July 2024 at 3 p.m. IST. The title of the seminar is The Current US Political Discourses on China. Details about the events can be found on the ICS website, or you can subscribe to our newsletter for regular updates. Thank you everyone for joining us today.
Thank you, everybody.
Thank you for having me,
and have a good evening.